One of the problems with recruiting for investment banking is not the knowledge or skills you acquire, but the access to talk with real investment bankers to put your best foot forward. Our sponsor, WSO Academy, can provide those connections with 60 head mentors who are finance professionals at top firms like Goldman, Centerview, and JP Morgan. Imagine being able to get on the phone within 24 hours with one of the Academy's 1,300 mentors right before a critical interview. Get on the waitlist for WSO Academy today by clicking the link in the show notes or by visiting wallstreetoasis.com/academy. All right. Welcome to Investment Banking Insights. This is the only show dedicated to helping you learn both the technical and non-technical aspects of investment banking. My name is Alex Mason, and I am your host. And it's good to be back. It's good to be back after taking a few days off. I'm so grateful to have you here. I hope you had a great Labor Day weekend if you were in the US here. And I know I certainly did. I just feel more refreshed, more recharged, ready for the week, ready for the day. And so I hope you are too. And I thought today we would switch gears yet again and go back to the technicals. We've been doing behaviorals for a couple of weeks. We had about 20 or so episodes focused strictly on behaviorals, but now I want to switch back again to get back into some of these technical concepts, specifically jumping into some of the more advanced concepts, because you know what? I think you're ready for it. You've made it this far through the show. You've gone through a lot of material with me. And let's go ahead and dive into advanced accounting now. Today's question is an advanced accounting question, which is specifically this: how is GAAP accounting different from tax accounting? How is GAAP accounting different from tax accounting? And the thing is, before we can answer this question, we have to understand what this means. So there's a few different accounting standards. There's the standard tax accounting, which is used by a lot of people. Think about filing your taxes every year and then paying income tax to the government. That's kind of like your standard tax accounting rules. And then there's GAAP. And by GAAP, I mean an acronym GAAP, which stands for Generally Accepted Accounting Principles. Generally Accepted Accounting Principles. And this system of GAAP is the standard system for business accounting in the United States. So it's important to know what that is and important to know what some of the differences are between this system and kind of your standard cookie cutter tax accounting system that maybe you and I use on a regular basis to file our taxes every year. So here are some of the differences. First of all, tax accounting is cash-based. So if you go to work at a job, you make some money via your salary, you get a certain amount of cash, and then you owe a percentage of that cash to the government. That's kind of the standard. GAAP is different. GAAP is accrual-based, which means that the timing of when goods and services are given or received might be different from when the cash is given or received. So that timing is accounted for in the GAAP rules. Whereas with tax accounting, it's all based on cash, so it doesn't account for when those goods or services are received or performed. Makes sense? So if you buy or sell something on credit, essentially, GAAP accounts for that, whereas tax accounting would not. It would just focus on the cash. Another difference is that GAAP accounting uses something called straight line depreciation, and tax accounting can use something called accelerated depreciation. And we haven't covered this concept yet. We've talked about depreciation certainly many times, but we've only talked about it in the concept of evenly depreciating something year over year. Well, it turns out there are other ways that we can do depreciation. And I'm sure we'll get into more examples of this later, but accelerated depreciation is kind of a different method for accounting for the value of assets going down over time. So there's some differences there. And then also, thirdly, GAAP accounting just does a better job of keeping track of your assets and liabilities. standard accounting rules do not really care about this. It's really just about revenue and expenses and how much tax is owed, again, based on the cash. Whereas GAAP accounting, it helps you track things like accounts payable or accounts receivable or the value of property, plant, and equipment. It's a lot more sophisticated in tracking the value of assets and liabilities over time. Okay, that's what I got for you today here on Investment Banking Insights. And I will see you next time. I hope you have an incredible day, an incredible week. All right, take care.